Same comparison now on the equity side is do these winners repeat? So we started in 2005. We had almost 47% of the managers that beat the index. So that means more didn't, right? Because we're comparing the whole bucket as 100%. So less than half of them did better, right? And did they repeat? 2006, 9% of them repeated their performance. 2007, 6. 2008, 2.2. 2009, 1% of them. So it's really, really hard to find a good manager that's going to repeat. And truth be told, there's studies that show that 97% of them really don't. That if you invest in an index, you're going to be at the highest, you're going to be up to, your performance is going to be equivalent to about the 97th percentile of investment managers. That there's only 3% routinely. And the unfortunate thing is it's usually not the same 3% that do this year after year after year. So, I mean, it's like, hey, it's your money, right? That's the name of the series. A good place to look at this data is from Standard & Poor's itself. And you can go to SPIVA. If you Google SPIVA, S-P-I-V-A, Standard & Poor's Index versus Active is what that stands for. And they do this kind of thing. And actually, a colleague of mine is a chartered financial analyst. And he'd be sitting in the back of the room clapping. I mean, and CFAs are people that are trained to manage active portfolios. He used to work for SPIVA. He used to actually put their reports together. He worked for Standard & Poor's in SPIVA. And he and I used to put together index portfolios for other advisors. I mean, it's like, Jeff, why do you do this? He says, because that other stuff doesn't work. You know, in spite of all his training and knowledge to actually go do that. And so there's no really cherry picking going on here. The absolute numbers will change. But one of the arguments for active management has always been around downturns. It's like, well, yeah, you know, when the markets are going up, and this is kind of the thinking is when markets are going up, anybody can do well. So of course, you know, that's when indexing will, you know, probably be better. But when everything turns down, that's when you want an active manager. Well, they did worse. Even worse than they normally do over that time frame when you look at that. I mean, the numbers just doesn't bear themselves out. So that's why, you know, we call what I'm talking about as an evidence-based approach. Is, you know, if the evidence shows this works, why wouldn't you do it when the other side doesn't really have much in the way of evidence? So here's another chart. And this chart, it's titled Randomness of Returns. And it's going from 96, just because we can only fit so many on a page. You can go back longer, and you're going to see a similar pattern, though it won't be identical because it's random, out to 2010. And what these are different areas of the market that are color-coded. And this is your legend down here on the bottom.
Is it each color represents a different index?
Right. Each color represents a different asset class. Okay? So we've got large cap, U.S., large cap value, small cap, which are small companies, U.S. small value, U.S. real estate, international large, international small value. We've got emerging markets. We've got 1-year U.S. fixed income, 5-year U.S. governments, and 5-year global. So that's a mix of high quality corporates and government bonds. Those are our different asset classes. that are all arranged here year by year from the highest return down to the lowest return. Looking at that, okay, let's look at the last, 5 and say, okay, where do you want to put your money in 2011?
Everywhere.
Hey, that's really the answer, is everywhere. Because that's the only way you know you're going to hold the leader realistically, and then you rebalance your portfolio accordingly. When one sector grows really, really out of whack because it's done well, you sell and you reallocate to the other ones, and you maintain this asset allocation, and it's a discipline. So you're constantly buying low and selling high, instead of doing the converse of what we saw most folks doing, is buying high and selling low. When you accept things are random instead of predictable, it totally changes your sense of what's possible and your approach. And when you're focused on, well, I'm going to be smarter than all the other investors in the world, and I'm going to figure this out, chances are, if you do, it's going to take you a really long time to get there, and you'll probably be broke before you get there. But it's a worthy thing to attempt to do. Portfolio structure, you want to minimize non-compensated risk. Focus on reducing these transaction costs, fees, and taxes. And now I'm going to give you, on the next slide, an example here. And normally this information is delivered across 5 different slides, but we don't have that kind of time. So we're going to have to jump from the beginning kind of to the end and see the difference. We're going to start with a typical portfolio, which is 60% equities and 40% bonds. And you would be surprised to know how many portfolios walks into my door, and this is what we've got, is something that looks pretty much like this. And they're usually large company, and that's what this one is. It's large. It's like the S&P 500. They're U.S. large companies. They have no international. They have no emerging markets, and they have a spattering of bonds, okay? And pretty much that's what this model is. And this study was done over from 1973 to 2009. So it's a good period of time there. So we can see what the portfolio mix is down here. And this is a fully diversified example, as opposed to just having 2 main sectors in the pie, which is our baseline example. Now, over this period of time, this portfolio had an annual compound return of 9.4%. That's pretty good. It's a pretty good number. And the standard deviation, this is a statistical term that's used to measure wobble, how much up and down movement there was 11.18%. Call it roughly 11, right? So we had almost 9.5 of return and a little over 11% of wobble. More returns better, less wobbles better. So that's the way we think about this, right? And then over the series of actual 5 different portfolios, we gradually become more diversified, okay? And what we do is, the first thing we do is we take those bonds, and instead of having them go out as far as 15 years, we cut them back to 5. And part of the reason for that is the risk-return trade-off on bonds typically is best when it's 7 years and shorter. Okay, if you go longer than that, you do get more return, but you get more wobble for every unit of increased return. Okay, so the risk-return scenario isn't very good. And then what we do is we take the 60%, which is all U.S. large companies to begin with, and equities, and we start dicing that up into different types of equities as follows. We change it to 7.5% U.S. small cap, 7.5% U.S. value. And value companies are companies that are selling at a low price relative to their accounting or their book value. So the market hasn't bid them up.
Do you use PE ratio? Is that
It would be a low PE too, okay, price to earnings ratio. So we've got small companies, U.S. Large value, U.S. targeted value, and what that is a sector of the portfolio tilted toward small companies that are also value, that don't have high stock prices. And we go international. We add in some international large, international small, international value, international small value. So basically we move out of the U.S. and we do the same thing, right? We start taking the portfolio and we make sure we get a little more value in there, and we start tilting it towards smaller companies as well, right? And what happens is these all have different, over periods of time, tendency to perform differently with different rates of return, and rates of return that flow at different times, high and low. So they have an offsetting factor toward one another. And we're taking and exposing the portfolio to sectors of the investment universe that have higher expected returns. And when we mix and match them in the right way, our risk and return trade-off actually gets better, right? And we also add some emerging markets. And that's down here, 6%. And these are the actual weights. Emerging markets are smaller countries like Eastern Europe, some of the Asian countries, Brazil, South America, those places, newer economies, right? And so let's look at the numbers. Initially, we had a 9.4% return and 11%, almost 11.2, 11.18 on the standard deviation. More returns better, lower standard deviations better. And what we're trying to do here is come up with a better mix, right? Because we don't want to take unnecessary risk, right? So the fully diversified model, and this example is what I'm calling smart diversification. In this portfolio, here we have, well, the initial one, the equities, we're talking about 500 companies. In this portfolio here, we're probably talking close to 10,000 companies. So we know some are going to be bottle rockets that go to the moon, and we know, well, actually, some are going to be Saturn V rockets that go to the moon, and others are going to be bottle rockets, right? That 4th of July, they go up 500 feet and they die in a relatively short period of time. So the return on the fully diversified portfolio is 11.6. Almost, we call that 200 basis points, 2 percentage points higher, with standard deviation of almost the same, 11.24. I mean, in statistical terms, it's the same number. It's not enough different. So it's
over the same period.
Over the same time frame.
3 to 2000.
Yeah, and this is just through setting up a portfolio in a way where you're trying to do it in an offsetting way to smooth the returns and maximize the returns. And this allows you to make a different decision then when you're setting up the financial plan as well. If I set my portfolio up this way, I need that much less equities because setting it up this way gives me a better return on that piece of the pie. And then I can use the bond section. I can have a larger bond section in secure bonds to secure my income stream. And that makes things safer going forward.